Welcome to the 2024 Economic Preparation and Depression channel. I'm your host, Tony. Thank you for joining me on this Saturday night brief edition, the last day of August 31st of 2024. We're just going to be talking about the inflation and the rates that are continuing in the jobs data that we got on Friday. And ladies and gentlemen, we continue to see right now, and this is a local newspaper here, I guess Dayton Daily News, they're saying that the lowering of interest rates too little too late, quote, for commercial properties, one local CEO says. Commercial properties have been hemorrhaging, as you know, with the commercial mortgage-backed security properties and all those properties like that. We're seeing building accelerated in most parts of the country in terms of gas stations, car washes, storage facilities for boats and RVs and other utilities, as well as we're seeing a lot of construction in apartments, new apartments and new townhouse construction going on in a lot of places in the Northeast, the Southeast, the Midwest, and the West. So that's been going on. But the anticipated rate cut that's coming in 2 weeks, or 1 to 2 weeks here by the Federal Reserve Bank, some believe it's too little too late. And we still don't know how much that's going to be. Is it going to be a 25 basis point or a 50 basis point or 75 basis point rate hike? We don't know yet, but we most expect it to be around 25 to 50 basis points there. And so they probably plan on making at least 3 cuts before the end of the year, as what many experts have seen. So you see building has slowed down in many of these communities, many of these neighborhoods here. And so the article goes on to say that lower rates may ease more money in the economy, and they can help companies wrestling with debt. But the problem is that the $1.5 trillion in U.S. commercial real estate debt faces a reckoning. It comes to a point where the amount of debt outstrips the rate, the interest rates, and they can't afford to service the debt and still build all these new communities and new commercial commercial properties here at the rate they were doing it before the health crisis, and also before we had all this money sloshing around before 2008, the crisis in 2008. So the developers are betting that they will have enough money to get these projects off the ground. They believe that they can pay it, they can get things serviced here. But my question is that it's not just the commercial real estate. It's also going to be there's an example. Here's a storage place I told you they're building. You see these all around town, these new storage places they're building, gas stations, car washes, and fast food joints. That's what America's excelling at building right now. And some of these, and also new townhomes and new apartment complexes, high-rise apartment complexes is going up everywhere. I mean, it's just crazy. But speaking about this economy, is that the problem is that so you may lower the rate, but you're having people with less money, less disposable income due to inflation here. This is the problem. Charting the global economy, inflation eases in the U.S. and Europe. They say this is good news. Shoppers here poised in I guess Georgetown and D.C. here, down in one of the districts here. You can see a bunch of empty bags and people just walking around and eating and stuff like that. Mainly it's used as an eating point down there in Northwest D.C. Many people go there for the fancy restaurants. But the inflation is cooling down according to Bloomberg.com, and that's good news for the economy. But the problem is that people have been tapped out. The credit cards are high. Credit card debt's at an all-time high. Student loan debt is at an all-time high, even though there've been some forgiveness. Some passages Supreme Court just end up blocking another passage of some of these student loans that need to be forgiven for some of these students. So the Fed's favorite inflation indicator increased by 0.2% in July as expected. Once again, the core personal consumption, or core spending measures, the CPE, that increased 0.02% in July, and that's up 2.6% from a year ago. This is just the official statistics. Unofficially, prices have been up, as you know, 5 to 8% since last year, and they continue to rise. And then, ladies and gentlemen, it's just safer to eat at home now. You saw the Boar's Head recall. I used to love going when I was in the South, living in the South, Florida, going to Publix and getting that Boar's Head, sub. They have a great deli department. But now with Boar's Head having all this recall stuff, maybe just to get the Publix sucker, just eat at home, make your own meats and make your own food or whatever you need to do, canning or stuff like that, because the food recalls are just getting out of hand. Even on the vegetables, they've had recalls on broccoli and all kinds of stuff. Smoothie mixes, like a lot of frozen fruits a couple months ago were being recalled from certain manufacturers like Trader Joe's and other places. So it's just a lot going on with that too. So that's going to cause the prices to rise in those areas on other goods and services that may not be recalled. So all-time inflation came in at 0.2%. That's in line with forecasts, but still, you look at the 2-year bond, the Treasury bonds, you're getting less yield on the 10-year and on the 30-year bond there, and not too much yield on the 2-year Treasury bonds. And so this is going to be a very dangerous situation here heading into the fall. So I do anticipate a slowdown, and I believe the safest place to be is being cash, and also into into not so much in the stock market, but in gold, silver, cash, and in tangible real estate, or tangible, I should say, not tangible real estate, but tangible goods and services like land, possibly some tangible goods that you can trade and get off liquid fast. So if you have older cars, I believe that the Cash for Clunkers is going to come back. That program is going to come back, as these interest rates on cars have just been way too high. A lot of people are maintaining cars. If you know how to maintain your cars, people are willing to pay for that service as well. And a lot of other things are going to be coming back. But the jobs data is what's going to help the Fed gauge the extent of the moderation. This according to Yahoo Finance, as you can see, the jobs data, we've been slowly hemorrhaging jobs in terms of initial and continuing jobless claims, which have been rising. We only gained 114,000 jobs in July. Average payrolls growth is not too hot either, and that's the problem, is that wages are not going to be able to keep up with this inflation once it really get going. It hadn't really gotten going yet, but it will get going probably by the second quarter of 2025. So after March, April 2025, all bets are off this summer in terms of wage growth outpacing inflation, if it ever was. Remember, I told you that, and we never had we've had COLAs, yes, a cost limit increase and all that, to everybody's pensions and different things like that, but we never had a real wage increase since like 1998 or something like that. So this is not good for the U.S. economy. But the good news is we still are adding jobs, and the good news is that people are still eating, and there's a lot of people that still have money to spend, despite us heading toward this supposedly this slowdown, this recession, allegedly. So that's what we have going on here. I just want to make that out. But I think that as we continue to get deeper and deeper into this recession, people are going to realize, hey, things are not all as rosy that we thought it was going to be, and we thought we would have more money to spend. And plus, we're sending a lot of money away. You got to remember, we're financing a lot of conflicts in Ukraine. And we're still financing conflicts, obviously, in the Middle East, and obviously in some of these other conflicts that we may get involved in, over toward the Far East as well. So that's going to add a lot to the expenditures too. And so the debt is just too high. It's too high of a debt to pay down in 10 or 20 years, and the manufacturing is not there. And so there's going to be a lot more empty, vacant properties in these cities as the suburbs. People, leave the suburbs and start thinking about moving to hinterland, getting small. Either people that live in the cities think about getting tiny houses or going back to apartment type living, high rises. Or that means that they're going to be going outside of the suburbs and getting a more of a homestead type of deal going on, if they can afford that, depending on what happens in the next 5 years. Those are going to be the kind of options that we're going to be looking at for the U.S. economy. And outside of the U.S., some developing nations may fare better, but everybody's going to be affected by this, as you know, because we're a global economy, and China and Russia and all the BRICS nations need somewhere to sell their goods and services and natural resources. So we're not going to go rock bottom, but we are going to be seeing a slowdown here, possibly coming up here by the second quarter of 2025. So there'll be more on that coming up in the coming weeks here. But I just want to say you guys have an awesome weekend. Get out, get some fresh air, enjoy your family, friends on this Labor Day. Happy Labor Day weekend. Thank you for all who served and have done service for this country and beyond. God bless you. And just keep mentally, spiritually, physically ready at all times, because we need to be flexible, all of us, in this economy. God bless. I'll talk to you soon later on. Thank you very much for listening.